Good day to all. This will be our discussions involving borrowing costs. For borrowing cost, our standard or related standard is PAS 23 borrowing costs. And here are our learning objectives for this particular standard or topic. We state the core principle of PAS 23 and we compute for capitalizable borrowing costs. So we will know what borrowing costs are later on and what should be capitalized or should be added as cost of the PPE item. So as to be discussed, core principle is that borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset form part of the cost of that asset. Now, still, the term borrowing cost is quite technical, but what do we mean by this? This means that borrowing costs actually are interest expenses or interest costs related to the loans and other borrowings that form part as the cost of the asset. So normally, if we borrow money, there would be interest expenses, correct? And these interest expenses, of course, are expenses supposedly. However, if such interest expenses, once again, are related to the acquisition, construction, or production of a certain asset that is called qualifying asset, which is not yet finished, but is to be made or produced or constructed. So in that case, we are going to capitalize or add to the cost of that particular asset. Since again, borrowing costs or interest expenses, as well as any other adjustments, let's say in relation to foreign currency changes or exchanges, which are actually normal with respect to exchange rates that are going to change every day. So there will be some adjustment factors. Such would also be included. This would also include like service charges. If we borrow money, there would be additional charges imposed. So all other costs are to be recognized as expense. To continue, here are also specific discussions for the borrowing cost as explained a while ago. But let us go back or have that once again. Interest and other costs incurred by an entity in connection with the borrowing of funds. And such may include the following. Interest expense calculated using the effective interest method, in which this method is the required one, wherein we are going to make use of an effective rate that is really prevalent for that particular loan or notes payable, meaning with respect to the borrowed money, and we are going to make an amortization table. So the interest expenses would vary with respect to the balance computed under effective interest method. Also, we need to include finance charges in respect of finance leases. So there could also be additional interest expenses. And as what I've said, if ever the borrowings are made in foreign currency denomination, so even the exchange differences, because there would be fluctuations on the values or amounts of the exchange rates, even on a daily basis. So at transaction date, when we borrow the money, the rates would be different. And later on, as we compute the interest expenses, wherein normally that's average. So we will discuss that in other accounting subjects. Our focus will be on borrowing costs. Now, qualifying asset is being defined here as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. In other words, it takes certain substantial material, significant period of time or amount of time for it to be finished or completed. And then, depending on the circumstances, any of the following may be qualifying assets. So here are as follows: inventories, manufacturing plants, power generation facilities, intangible assets, and investment properties measured under the cost model. However, our topic is all about property, plant, and equipment, so we might look into BC only. Since inventories are part of IAS 2, inventories, intangible assets, part of IAS 38, which will be tackled also in this course, Intermediate Accounting Part 2, and then, or Part 1B for the curriculum. And then inventories, that's already part of the previous intermediate accounting. So investment properties are long-term investments also tackled in the previous intermediate accounting courses talking about investments. So investment properties, which are measured under fair value model, are basically not part here. Only the cost model will be part of the so-called qualifying assets. So the reason is that since those investment properties are already reflected at fair values, therefore, no need to include our interest expenses as we go along the way. So they will have to be expensed immediately, not capitalized during the duration. However, for the cost model, we will apply this particular standard. Now, inventories also are to be part if it would take substantial period of time to construct or make it, but if ever it is of a nature that is repetitive and routinary, so in that case, even if in large quantities, they are going to be excluded, not part of qualifying assets. So this is what I've mentioned a while ago, like wines, wherein they are normally kept for years, very substantial period of time. However, because they are routinely manufactured, so they are not part of the qualifying assets. Anyway, going back also for the qualifying assets, we have to take note that let's say a certain organization or business is selling ships or airplanes. In that case, they're part of inventories. They're qualifying assets because to construct them, such would take substantial or substantive or material or significant period of time. The following are not qualifying assets. As explained a while ago, financial assets and inventories that are to be produced over a short period of time. Question could be, what is considered short period of time? Normally in financial accounting, we say 1 year or less. If more, normally that's substantial, but it might be a case-to-case basis as well. Letter B, assets that are ready for their intended use or sale when acquired, they're not part. C, we're done. And the assets measured at fair value as explained a while ago. Then commencement or start of capitalization, it would begin as part of the cost of a qualifying asset. The it is the borrowing cost on the date when all of the following conditions are actually met. So we have the entity incurs expenditures for the asset. So expenses are actually being incurred, being considered, recognized. Then the borrowing costs are also incurred. Expenditures for the asset will be all other or all expenses which are to be made for the construction of a qualifying asset. So example, borrowing of the money, then the proceeds will be applied for the acquisition of the raw materials, payment of direct labor, and all other costs needed like factory overhead. Letter B will be the entity incurs borrowing costs, so the interest expenses and service charges and all, including the foreign exchange rates. And letter C, it undertakes activities that are necessary to prepare the asset for its intended use or sale. Meaning we are now doing the tasks from step 1 and so on, so that we'll be able to finish and complete all activities for the completion of our qualifying asset. For this part here, this is all about suspension. So when we are going to stop or postpone for the meantime the capitalization, this can happen when there is or are extended period or periods of suspension of active development of a qualifying asset. Take note of the word extended periods of suspension. So it's okay then to suspend temporarily, since that may be part, for example, like we need to pause certain activities of the construction to rest and all. So normal things, or that would not stop active development. So in that case, we still have to continue capitalization of the borrowing cost or capitalizing borrowing costs. However, if, for example, there's already a delay over extended periods of time for the active development, then we are going to suspend the capitalization. Next is cessation. So when do we really stop? When we look at the activities and substantially all the activities are completed in order for the qualifying asset to be ready for its intended use or sale. So substantial is quite case-to-case basis. So it's going to be a matter of what is really material or significant of a certain case or situation. But overall, we can just say that if ever, for example, that asset is really close to completion or it's almost usable. For a building, for example, let's say there are just some finishing touches that are to be made. In that case, that's substantial completion already. Then how do we compute or determine the borrowing cost eligible for capitalization? Now, it can be that there would only be specific borrowing wherein we borrow money from certain financial institutions to finance our respective construction of qualifying asset, and any expenses will have to be capitalized if ever the loan is specific, but it can also be general, like we borrow money for a lot of purposes, and one of the purpose is for the construction of qualifying asset, and that would involve another formula or combination of the two. Let's begin with just specifics. So in this case, whatever is the actual interest expense on the specific borrowing, we just have to deduct any investment income earned on the specific borrowing, and that is the borrowing cost eligible for capitalization. If no investment income earned, of course, interest expense on the specific borrowing is equal to the borrowing cost eligible for capitalization. Then, after that, what about for general borrowing? So we have the total interest expense on general borrowing. So again, for all purposes of the company in which such borrowed money, we divide that with the total general borrowings. So we will get now the capitalization rate. All expenditures spent, expenditures, by the way, are all payments and disbursements made for the construction of qualifying asset. Again, to purchase raw materials, to pay for direct labor and all factory overhead. So all those items which are needed for the completion of qualifying asset will have to be placed to be multiplied by the capitalization rate of that percentage, and we get borrowing costs that may be eligible for capitalization. And then whatever is the average expenditure, we multiply that with the capitalization rate obtained, and we will get that borrowing cost. So the amount computed in the formula above shall be compared with the actual borrowing costs incurred during the period. And then the amount to be capitalized should be lower. So whatever we got here, the borrowing cost that may be eligible for capitalization, we compare that with the actual borrowing cost. So whichever is lower. Now the actual borrowing cost will be, of course, the total interest expenses with respect to the borrowings. And when we say the actual one, we meant the total interest expense on general borrowings. Now, what about if mixture? So in this case, if mixture, we can do the traditional approach or the contemporary approach. For the specific borrowing, that's going to be the same. For general borrowing, that's the same formula. However, we are going to deduct whatever is the amount of the loan for specific borrowing from the average expenditures, and any difference will be multiplied to capitalization rate. And we get the borrowing cost from general borrowing, and we get the total from the specific borrowing and the general borrowing. This amount will have to be compared once again to the total actual interest expenses for the period, and we choose the lower. The purpose of choosing the lower is to be conservative so that the value or the cost of our PPE will not be overstated by whatever borrowing cost that we have computed using the formulas, wherein the actual is just lower. Then what about contemporary? So contemporary is as is whatever formulas that we have known from our 1 and 2. So specific and general, that's it. We get the total of the borrowing cost from either of the borrowings, or what we meant is both. And then whatever is the lower amount will be considered. So the lower of the actual borrowing cost or the total interest expenses for the period versus the computed under avoidable interest method or contemporary. Traditional is also known as average accumulated expenditure method, while contemporary is the avoidable interest method, meaning had we not entered into the construction contract, then you would not have incurred the interest. And the financial statement presentation is going to involve for qualifying assets which are not needed to be segregated from other assets in the financial statements. They are to be presented as regular assets under their normal classification as provided under other standards. So normally when we present them on the face of financial statements, they will be mixed with other assets like investment properties, inventories, property, plant, and equipment, intangible assets. So these are the line items on the face of financial statements. Normally, non-current assets with the exception of inventories. And then the details will be found in the notes to financial statements. All right, so we are at the end already of our discussions about borrowing costs. Hopefully you got something from our discussions. Thank you very much and see you in another discussion videos.